So we are wrapping up the session. We are wrapping up the week here in Europe. We are surging into the end of the week. It's been a really solid week, I have to say, for European equities. I'm going to talk you through today. What we've seen today is the CAC up by 1.3, the DAX is up by 1.3, London lagging a little bit, up 0.8%, but a solid session. Just about every single sector is in positive territory. It's been a really solid story. Let me show you the session as how it has developed. Remember, we've been up on the week, so this is the last day, but as you can see, a gap higher first thing this morning, but it's been a quiet start, but then a kind of incremental, slow build towards quite a crescendo that has taken us up nearly 2% over the last few days. Remember, the preceding period saw some significant losses. So we bounced back off those. The dip has been bought. The market has come back strongly. Let's talk a little bit about what the sector story looks like, just to give you an idea of what has happened there as well. This is the last 5 days. Banks, the outperformers. Retail has done well. Cars have done well, technology has done well. There's only one sector in negative territory, that is the healthcare sector. Relatively crowded trade here in Europe on the defensive side. Food and beverage has not had a good week as well. The grocers have underperformed too. So the defensive end of the market, the staple end of the market, has underperformed this week, which tells you about the kind of the risk on narrative that we have seen. Banks, as I say, the outperformers. In terms of the day, let's talk about some of the news we've seen. All three of these stocks are in negative territory. IAG, I use IAG as a vehicle to tell a story about Heathrow. Obviously, the big dominant user of Terminal 5 at Heathrow, British Airways, owned by IAG. Got a new CEO coming in to Heathrow. Is that going to represent a reset for the relationship between the airport and the airlines, ultimately the customers in this process? That's going to be a very interesting story to see. We're going to see Thomas Woodby coming in. He's coming from Copenhagen, where he's run that airport for, I think, the last decade. We've moved on quite quickly. I was going to show you some other stocks, but okay, I'm being told that I basically have to move on, I think, maybe. Next week, Monday, we get manufacturing PMI data. Tuesday, we get the Reserve Bank of Australia decision. Remember, that's caught us by surprise. OPEC International Seminar. The oil price is a sensational story at the moment. German factory orders are going to be coming through at the end of the week. And then, one of the nicest gigs. Going to Sintra is quite nice. Going to Aix is definitely up there as well. The Aix-en-Provence Economic Forum is going to be taking place in the south of France, in Provence, the Luberon, I guess, probably, more accurately. An absolutely sensational few days. We've got some great guests lined up from there. So Shanali, next week is going to be an interesting one. We've also had some inflation data. I think all of those people at Aix are going to be digesting as well. Plus, we need to think about what the second half of the year is going to look like.
That is absolutely right. It's a big moment. It is the start of the second half after a very big first half, and it brings us to our second question, or our first question rather, of the day, and it's, do you make a halftime adjustment? Joining us to discuss this is Melanie DeBono, Senior Europe Economics Strategist at Pantheon Macroeconomics. Melanie, when you think about this, just how exuberant the first half has been relative to all the bad news that's been expected, how do you see adjustments being made to kind of cater to the second half of this year?
At this point, I mean, the first half was better than expected, but still the Eurozone was in a technical recession, having contracted in 0.1% in both Q4 and Q1. And the incoming surveys have started to weaken, turning in line with what we've been seeing in the leading money indicators, which is that actually the Eurozone economy is going to remain exceptionally weak. Whether or not we rip up the script at this point, no, because the data and the surveys are coming our way in pointing to continued weakness in the Eurozone economy for the coming quarters.
We have, though, Melanie, in the first half of the year seen very sticky core inflation. Do we see very sticky core inflation in the second half of the year?
So core inflation rose in June, which is, of course, the biggest story of today. So the headline inflation rate in the Eurozone came down despite that increase. And that increase was driven by base effects related to transport services in Germany. This factor will keep the core rate quite elevated for the coming 2 months, so we expect that it will stay around that 5.3, 5.4% mark all the way until August. But then the tide will turn. Non-energy goods inflation is weakening, and therefore we expect the core rate to come down quite sharply after August.
Melanie, how do you think about the direction of travel for rates here, given where inflation is right now? Is there kind of any potential risk of more upside than the market is expecting?
Definitely. So at this point, the ECB has all but promised a July rate hike, and given that inflation has averaged 6.2% in Q2, which is what the ECB expected, it will go ahead with that hike. The question mark is over September, and given recent hawkish speak coming out of Sintra, we expect that the ECB will go again. And now, given that they're focusing on this unit labor costs, which will continue to rise, the risk is clearly towards further hikes come Q4.
Melanie, what happens if the PBOC, what happens if the Chinese authorities deliver massive stimulus in the second half of the year? Is that going to mean that the ECB has to remain hawkish for longer? How will that change the narrative? Because the first half of the year we thought the Chinese economy was going to roar, and it didn't. It fizzled. If it roars in the second half, how is that going to change the narrative?
Well, if the Chinese economy does pick up speed, at this point, what it's exporting is disinflation. So it will not change the outlook for inflation materially in the Eurozone unless, that is, there is a stark pickup in Chinese demand for natural gas. So at this point, wholesale or natural gas price futures already point to an increase in gas prices in the Eurozone because demand will increase as European governments again try to refill this gas storages, the story that we saw last year, which led to sharp increases in prices. So if we see that Chinese demand for natural gas picks up really sharply, then there is a risk of upside in energy inflation, particularly in the Eurozone, but base effects should continue to offset this for the remainder of the year. So we do not think that a Chinese rebound or a pickup in Chinese growth will actually be inflationary for the Eurozone.
When you think about the inflation story over in Europe, how much is there really much more ability to keep passing on prices? I think that worldwide there's really a question about margins coming under further pressure because of this lack of ability just to keep going.
Yes, and in fact, we've been seeing a lot in the surveys of, particularly within manufacturing, firms are seeing a very sharp fall in their input costs. And they've stopped pushing through those stark increases in prices, which is why we're now seeing disinflation in goods. The problem is that in services, we're not seeing that yet. And that's because although services firms have also seen their electricity bills come down, they're getting higher wage demands. So workers are requiring higher wages, and therefore they're still seeing high input costs, and they're still trying to push those on to customers. So that is, in fact, the biggest risk to the inflation outlook in the Eurozone at the moment.
Melanie, what surprised you the most in the first half? What didn't you expect that we've seen?
Well, in the first half, the biggest surprise was the resilience of the economy, because for us, we were seeing this rollover in the money data, which meant that consumers were pulling out their deposits and very quickly. And although some of it was perhaps to move them into longer dated deposits, that is usually a sign that precedes a recession in the Eurozone. So the resilience is what's come as the biggest surprise.
How much tighter do financial conditions really get from here, given the sense that things might need to be tighter than expected?
Well, at this point, if the ECB continues to tighten, then financial conditions will tighten further. We've already seen banks passing on the higher interest rates to those requesting a new mortgage or requesting a new loan. Interest rates are rising, and they've also tightened credit standards materially. And if there's a continued squeeze on banks' margins, which it looks likely at this point, then they will continue to do that, basically passing on the hurt to the consumer, which in effect is what will happen. That's how the ECB will manage to lower aggregate demand in the economy.
That's how transmission works.
Exactly. It has acknowledged for a very long time that for inflation to come down, the economic growth has to slow.
Yep, it's a blunt tool, but it's all they've got. Melanie, great to see you. Thank you very much indeed. Melanie De Bono, Senior European Economist, joining us from Pantheon Macroeconomics. European markets are now closed for the week. Little tick lower as we come through towards the end of the day, but still a positive session, as you can see, for the FTSE, the DAX and the CAC 40. Coming up, we're going to turn to Shonali's favourite subjects. Big banks waiting for the Fed stress test results to resume dividends and buybacks. We're going to talk all things banking with Aaron Klein, Brookings Senior Fellow in Economic Studies and the Deputy Assistant Secretary at the US Treasury, former, I think. That's next. This is Bloomberg.
Now, the biggest of U.S. banks will be allowed to resume dividend payments and share buybacks. We expect announcements today as long as they pass the Federal Reserve stress test. As you know, all of them did. Joining us now is Aaron Klein. He's Brookings Senior Fellow in Economic Studies and the former Deputy Assistant Treasury to the U.S. Treasury Secretary. Aaron, you know, it's interesting because when you look at the Fed stress tests, all of them all of them passed the stress tests, including failed banks like Credit Suisse, for example. And so there's a lot of question about whether these stress tests are doing what they're supposed to and whether there will be more comfort in big banks really resuming capital return at this time when people are so worried about the economy.
Well, look, the Fed has really doubled down on these stress tests even when they haven't worked. They've made mistakes. Look at Silicon Valley Bank. The stress test for years didn't consider a sharp raise in interest rate scenarios, which is exactly what brought down Silicon Valley and First Republic. And so it's always hard to measure bank capital. There are a lot of different ways to do it. Simple to more complex. The Fed seems to favor more complex rules and then be guided by some of these test results, sometimes despite common sense. Believe the model over your eyes sometimes is part of the problem.
Absolutely. Aaron, we're in a situation where the stress tests basically tell us that the big US banks don't need extra capital, yet we're going to see some global regulations kick in that probably are going to require extra capital. Which one of those two situations is right?
Well, look, I think that you fundamentally have to ask yourself, what's the core problem? Is the core problem that banks are too undercapitalized and they're subject to failure? Is the core problem that we're not measuring the right risks and right amount of capital? Or is the core problem that banks that fail, we don't have a system with how to deal with it? I think in the case of Silicon Valley Bank, the regulators panicked a bit in case of that failure and reversed themselves. They'd said that it wasn't systemic before, and then when it came time to let it go, they got too afraid. So I think the regulators need to think more carefully about how they could let an institution fail than try to devise a system in which failure will never occur. Because ultimately it will. Ultimately, the next risk will look different than the past, and the test we have won't catch it. And you can't just keep going back to say, oh, well, we'll just make the test better.
You know, they're the tests themselves, Aaron, but then there's this other issue here, this argument you could make that the system as it exists today incentivizes some of the problems that we have seen brewing in the regional banking system, particularly the idea here that the FHLB borrowings have more than doubled for more than 80 banks in the country, and this idea here that some of this lending has been incentivized by the structures that exist in the system. What do you think of that argument?
I think that's entirely true. Look, the home loan bank system that you referred to, Silicon Valley Bank went from zero to the number one borrower from the San Francisco Home Loan Bank. And you know, number two was First Republic. We have an over-reliance on that type of system for a small number of institutions without the regulatory oversight and scrutiny. Now, when the crisis happens, a lot of folks flood to the home loan bank system, and that makes sense, and there's some value there. But when you start looking at individual institutions that are often more problematic, you see that they're leaning into the home loan bank system well before the crisis. It's what we saw with Countrywide and Bank of America and Washington Mutual in 2008, and we saw it again with Silicon Valley and First Republic. Again, unfortunately, the regulators are not leaning in to address these problems, but instead are saying, oh, well, we're just going to make a better stress test for the future, a reverse stress test.
Do you think that they should, in particular when it comes to the FHLB officials, should they be paid as federal employees rather than kind of leaders of a bank?
It's nuts. These 12 home loan bank folks are making millions of dollars a year. I think the Federal Reserve regional banks is a fair model for them in that compensation. It's higher than government employees, but far less than what they're earning. And the incentive compensation structure at some of these home loan banks incentivizes the home loan bank to grow bigger. That's not necessarily what's in the best interest of the economy.
Switching gears just a little bit here, what do you think, you had President Biden in kind of the scope of his conversation around Bidenomics address this other issue, not of the smaller banks, but of the bigger ones and overdraft fees. Is this a realistic place to be going for the Biden administration, especially given some of the sharp pushback some of the big banks have already given about the idea of overdraft protection actually helping in some regards too?
So I think this is a huge success both of President Biden and of the large banks. Overdraft fees have come down. The large banks have voluntarily changed their overdraft policies in ways that should return $5 billion a year or more, according to consumers, according to my estimates. I mean, you're looking at $1 billion a year from some of the largest institutions going right back into the pockets of people who are working paycheck to paycheck. And there was no new law, there was no regulation. The Biden administration talked a good game, but ultimately the industry on its own changed its policies in ways that'll make the system far more fair for working people.
So, Aaron, we're in a situation where the industry can, in certain instances, self-regulate, but needs help in other areas. And the different cap scale banks obviously have different regulations and need different kinds of help. How far away are we from a regulatory structure that is more tailored to individual banks, that allows individual banks to exist and have different business models and to be managed on a case-by-case basis? It feels like we're still in we are in this world of one size fits all, or at least in brackets, one size fits all.
Yeah.
How far away are we from being able to tailor what we do in terms of regulation?
Well, look, tailoring sounds good if you get the measurements right. And if it's mistailored, you can look pretty bad, right? So I don't think we're in a one-size-fits-all, but I think we have sizes: small, medium, large, extra large, double XL, triple XL, right? I think you can play with this analogy in a little bit and see the truth there. You want some tailoring. But on the other hand, there's some products and practices that banks have gone into. I've documented a few small banks that are overdraft giants. You ever hear of Wood Forest Bank? They made more money in overdraft fees than Citibank because that's their whole business model. So some tailoring may mean regulatory relief, but in my world, where I think the regulators had a little more courage to go after bad practices, then some of this tailored regulation would be very, very challenging for a few of the banks, particularly some of these smaller ones that I think are really drifted far from their core mission of banking and are just fee-generating machines.
You know, it's interesting, fee-generating machines. There's this question here about what fees look like for the regional banking system moving forward, given how much they've borrowed at higher rates. I mean, Aaron, how concerned are you about the system moving forward as these perennial issues really start to compound?
Yeah, so I think the regional banks are actually better off than people appreciate. Silicon Valley Bank was not a regional bank. It had 4 branches. I mean, a bank of its size is a quote-unquote regional bank has 1,000 branches. Silicon Valley had 4. First Republic had under 100. What you dealt with were specialty banks. They dealt with venture capital. They dealt with uber wealthy people. They weren't really kind of your core regional bank. America has 4,500 banks. It's a comparative advantage, and we need to keep a system with diversity of size in banking. And I think there's a place for banks of all sizes in the future of this country.
I suspect that Shonali could continue with this conversation all afternoon.
A dream about
Aaron, we're going to... Oh, yeah. We're going to wrap it up there. Great to see you. Thanks for spending some time with us. We really appreciate it. Aaron Klein, Brookings Senior Fellow and former Treasury official. This is Bloomberg.
About that all day yesterday.
We might be off the session highs, but the stocks are still up today. We are looking at the bulls out to play. Abigail Doolittle is checking the move.
They certainly are, Shonali, and a lot of it has to do with Apple. Let's take a look at Apple, not just on the week. Initially, I was going to put in a one-week board, but it turns out Apple is up for a 7th straight week in a row, the longest winning streak since July of 2021. So why not take a look at all of it, up 11.2%. But to Shonali's point, here is this big pop higher for Apple, really propelling stocks up today above that $3 trillion market cap spot, one of the biggest company in the world, the first company to do that. But in terms of the illustrious business business that they have with the iPhone and, of course, the balance sheet. However, we may see some consolidation. This is a big move. But that's not the story of the quarter. Let's take a look at the quarter for stocks. There's the NASDAQ 100 up 15%. The Russell 2000, even though it's lagging, up 5%. I would argue this may be the bigger story, though. We have that 2-year yield backing up 85 basis points now at a 486, really looking basically right past this Silicon Valley Bank, the regional bank turmoil, but crude oil not participating. So there's a little bit of a mixed message here because crude oil, a risk asset, a tell on the economy, not really agreeing with stock investors' assessment of what is ahead. Now, for the first half, of course, we're looking at big gains for the NASDAQ 100 here, too. In fact, we are looking at the record, the best first half for the NASDAQ 100 ever, with it gaining at this point 38.6%. Now, the rest of these bars, these are annual bars. So you can see that the NASDAQ 100 right now doing better than it does typically in most years, and we're only halfway through. But let's bring back oil into the picture because we are seeing an interesting divergence on the year, one that should be worrisome to investors, I would argue, at least if you look at the past. So here we have the NASDAQ 100 up top, up 38.8%. Here is the Bloomberg Commodity Index down 13%. When you tend to have that kind of divergence, Guy, between risk assets, one side is going to be quote unquote right. In the past, commodities tend to lead. Probably a lot of sensitivity to the Fed interest rate policy, the hiking here. Going to be interesting.
That chart encapsulates the first half. Be interesting to see what it looks like at the end of the year. Abigail, thank you very much indeed. Abigail Doolittle, what are we watching for the rest of the day? We now understand that President Biden will announce new actions to protect student loan borrowers. This, of course, after the Supreme Court ruling that tossed out his relief plan. He's going to speak a little bit later. Coming up, the Race Capital General Partner joins us on Bloomberg Technology with Ed Ludlow. Looking forward to that conversation. This is Bloomberg. Have a great weekend, everyone.
heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Ed Ludlow here in San Francisco. Caroline Hyde's off today. This is Bloomberg Technology. Coming up on the program, Apple hits a $3 trillion valuation. Will we close above that historic market cap milestone? Remains to be seen. The co-founder of DeepMind, now the CEO of Inflection AI. He discusses the potential of his company after raising a whopping $1.3 billion. And more trouble for Adobe's purchase of Figma, with the UK joining the EU and US in multiple probes of that $20 billion deal. Such a big week in the world of technology. This is the market's picture. NASDAQ 100 up 1.4%. The story in the last couple of days has been yields higher. We're softer by about 2 basis points, 3.8% on the US 10-year yield. Semiconductors also kind of trading in line with the broader tech sector. Bitcoin moving to the downside. We kind of pulled back a little, right? Below 31,000 US dollars per token, back down towards 30,000 US dollars per token. This week it was a little bit about the Fed, right? The idea that we will get 2 rate hikes by the end of the year, and Jay Powell, the Fed chair, ruling out a recession as a likely scenario. That has impacted the technology sector. The here and now is about the Supreme Court throwing out Joe Biden's policy on loan forgiveness, student loan easement, bring out some of the stocks impacted. We saw some really wild swings in SoFi, and we will get into that later in the program. It actually caused a halt at one point. We're down by more than 3%. Look at Bloomberg Intelligence's reaction. They're saying, actually, this could do really well for a fintech platform like SoFi when people rethink borrowing. Target is not technically a tech name, right? But it's down 1%. The logic being that this could impact the consumer if they're having to have some pressure from their student loan finances. But there is one big story this Friday, and it is Apple, the first company ever to hit a $3 trillion market cap. And this chart tells the story. Look at the $900 billion of market cap we've added so far in 2023. What is the story here? We will get to it in just a moment, but I remind you, last time we were near that level was at the beginning of 2022. It's taken us that long to get back. There is one person you want to speak to on a day like today, and it is Bloomberg's Mark Gurman. Mark, you cover this company as close as any journalist on the planet. I want to start by asking you, what kind of a moment is this? What kind of a milestone in technology history is registering a $3 trillion market cap?
Ed, thank you so much for having me. Obviously, this is an incredibly big milestone for Apple or any technology company, really. And for Apple to do this, to get back to where it was in early 2022, you saw what happened to the broader market over the last year or so, and to really come back up that mountain and get back to here is a big moment for the company. I think that you saw a slew of departures, not only at the executive level, but maybe at the mid-level or lower level of the company. And one continued theme on those departures was people felt like their RSUs or the restricted stock units would not really pay out as much money as maybe they can earn at another company, right? And the stock coming back up, right? I think that could be a key way that Apple will be able to retain people moving forward as well. It adds new excitement to the rank and file at the company. They know what they're working towards in terms of an ultimate payout. For the consumer, it doesn't really have an impact, but I think internally at Apple, it is something they'll never say, but I think it is quite a positive moment.
That deep reporting is such a good point as well. It has not yet been brought up in our coverage on Bloomberg Television of the $3 trillion milestone. The short-term story for the consumer has been about Vision Pro, but you argue in today's Tech Daily that actually, if you think about the $3 trillion market cap, it's not got much to do with Vision Pro at all. What's your point?
Yeah, I think we would hit this $3 trillion market cap whether or not Apple announced the Vision Pro headset in June at the developers conference or not. I think the Vision Pro story, very long-term for Apple could become an Apple Watch or iPad-sized opportunity, which is about $25 billion annually to the bottom line, and that's in the real long term. In the short term, you're not likely to see this generate more than $2 to $4 billion a year annually for Apple, which is essentially very small. It's 1% to 2% of their overall annual revenue. It's really the ecosystem play, right? It's the idea that the ecosystem locks you in and such where you're going to own an iPhone, an iPad, a Mac, and then every few years or so, you're going to upgrade to new models. On top of that, you're going to subscribe to services. You're going to use Apple Care. You're going to visit Apple retail stores. You're going to buy more accessories like AirPods, the Apple Watch, and maybe one day the Vision Pro at a cheaper price as well, right? And so that stickiness, the idea where consumers are willing to spend extra, they're really willing to shell out for a new iPhone, the priciest iPhone with the most storage you can get. That's what makes this company so lucrative and so special to the shareholder. One really important aspect that we also haven't touched upon about this $3 trillion measure is that we're heading right into iPhone season. Believe it or not, we're only about 2 months away from the iPhone 15 going on sale. The iPhone 15 is going to be a pretty significant upgrade on both the low-end models and the high-end models for the first time in 3 years since the iPhone 12 launched in 2020. New design, big camera improvements, changes to the display on the cheaper models. You're going to see another big iPhone upgrade cycle. And so I think consumers are excited to only be 8 weeks away from that, and shareholders see that excitement. And so you're likely to see a big influx of purchases in just a few months, which obviously is going to drive attention to purchasing the stock too.
Mark, quickly, the one phrase or word you haven't used is artificial intelligence. Why are we not talking about Apple in the context of artificial intelligence?
Because Apple has really set out this recent AI boom, right? Over the past year or so, you've seen Microsoft, Google, obviously OpenAI with ChatGPT. You've seen Amazon all throw around the buzzword and talking about their new generative AI, chatbots and such. Apple has really stood on the sidelines here. And I don't anticipate any significant new AI-related service from Apple to launch until the tail end of 2024, calendar year 2024 at the earliest. So there's not much there. I know there's been some speculation from analysts and such that Apple is nearing some sort of generative AI ecosystem. There's nothing coming soon, and so I don't really think that could be priced into the stock as of yet. And I don't necessarily think that Apple is planning very significant AI initiatives other than a new AI-based health coaching service for next year. But obviously, the mother of all AI projects, as Tim Cook has said, is the company's self-driving car. You're unlikely to see that at least for another 4 years or so.
Yeah, you and I have done a lot of digging on the subject of an Apple self-driving car. We'll stick with it. Bloomberg's Mark Gurman, everything Apple. Thank you so much. Happy Friday. All right, that's top story number one. Top story number two, we go to the UK, where antitrust regulators are launching an in-depth investigation into Adobe's $20 billion purchase of Figma. Let's get the details. Bloomberg's Catherine Gemmell live for us in London. Catherine, what do we know?
Hi Ed, thanks very much for having me. So what we know today is that the CMA, so the Competition and Markets Authority, has said that the Adobe Figma deal will need an in-depth investigation unless the companies offer any remedies up to, solve these antitrust problems that they have found in the first stage of this investigation. The main concerns from the CMA are that within the design platform and the supply of screen tools as well. And these are two areas where Adobe and Figma really compete. And the main concerns are that if Adobe buys Figma, then that means that they're really going to take that competition away, and that could lead to a rise in prices for customers and could also stifle innovation.
We're just showing the shares of Adobe up 1.6%, near session highs. When you get a headline like this, sometimes the stocks react negatively because the market's thinking, wow, maybe this deal won't happen. Is that the situation we're in now? How serious is this development in the context of the deal actually getting done?
Look, it's too early right now to know whether it's serious or not. These sort of deals will obviously always get some scrutiny. This particular deal is also getting scrutiny at the DOJ in the US and is potentially facing scrutiny in Europe. So, we'll need to, find out what the CMA finds in its potential phase 2 investigation, whether we know it's going to be serious or not. These are just the stages that these sorts of deals have to go through, and of course, that the CMA, that consumers in the UK rely on the CMA to make sure that consumers are getting a good deal.
Bloomberg's Catherine Gemmelman in London. How often is this happening? The trifecta, US, EU, UK regulators, when we're talking about a tech deal. Great reporting this Friday. We'll stick with it. Now, coming up, Inflection AI's CEO is going to join us to discuss the company's $1.3 billion fundraise, and it came from the likes of Reid Hoffman, Bill Gates, and NVIDIA. Big conversation coming up. This is Bloomberg Technology. Inflection AI has just announced it's raised $1.3 billion in funding from investors like NVIDIA. And earlier this year, Inflection AI launched its first product, a chatbot called Pi, a personally modeled AI chatbot. Inflection AI's CEO and co-founder, Mustafa Suleyman, joins us from London. Interestingly, congratulations, what is frankly a monster round. Why did you need to raise that much money?
Thanks, Ed. Yeah, great to be with you and appreciate the congrats. I mean, you know, we're really building the cutting edge of machine learning models today in order to create Pi, our conversational AI, and that requires vast amounts of compute. I mean, we're actually constructing the largest supercomputer in the world today built on NVIDIA's H100 chips. And that's obviously very expensive, but as a startup, it actually enables us to get the best of both worlds, have, you know, the kind of resources that you might otherwise expect in a big tech company, but also the speed, agility, and super high quality talent that you get when you bring together the kinds of folks that have been involved in building all the last generation of models at DeepMind, OpenAI, and at Google.
All the attention goes to NVIDIA because they are participating in this round, Mustafa, but you are building the underlying LLM or foundation model using their H100 GPUs.
Yeah, I mean, we have an incredible partnership with them. They've been fantastic to us. Not only are they investing in this round, but they made us their key partner to get access to H100s, and we've built a really powerful cluster with them. Just a couple days ago, we announced that we have the fastest performing AI cluster in the world, and in a few months' time, we will have increased the size of that cluster to be the second largest supercomputer on the planet, which is just an incredible opportunity, and so we're super grateful for their partnership, but also the partnership with Microsoft. You know, we use Azure. They have an incredible cluster there, and their AI infrastructure is also second to none.
Mustafa, when I bumped into you in the corridor of Bloomberg Technology Summit last week, I reminded you of something you said on stage about AI development being a meritocracy. You mentioned that in passing, but I wondered if you could elaborate on what you meant by that.
Well, it's a meritocracy in the sense that, the cutting edge is also being open sourced and made available to millions of developers around the world to adapt, innovate, and experiment. And it's kind of an incredibly interesting time because on the one hand, models are getting bigger and better, and on the other, they're also getting more efficient, smaller, and cheaper to run. So both directions of progress are really being turbocharged in this new wave of AI, and that's incredibly meritocratic. And we're seeing huge innovation at both ends of the spectrum.
Supercharged and in a meritocratic way, but you guys kind of have a big advantage in the access to the H100s and the compute that the GPUs provide. Is there a way you can kind of quantify the advantage for me? I think a lot of people will say, okay, we have Inflection AI and Pi. How is it similar and or different to OpenAI and GPT 3.5? What is the difference technologically and the goals as well?
Yeah, it's a fair question. So our most recent LLM, which is called Inflection 1, is actually better on all of the public benchmarks than Google's Palm 1, DeepMind's Chinchilla, and OpenAI's GPT 3.5, which is a great achievement for a small organization like ours. In terms of the total amount of compute that we have, the 22,000 H100s in aggregate represents 3 times more computation than was required to train GPT-4, according to the best guesses of the rumors online these days. So it is a seismic amount of compute, and it gives us an enormous advantage because we're really concerned with building the absolute cutting edge. Like, we really want to build the absolute best experiences in the world so that when you get access to your personal AI, Pi, it's going to be aligned with your interests and on your team, and increasingly be able to do useful things for you. It will book, appointments for you. It will plan holidays. It will, buy things for you and be a scheduler. And everybody's been waiting for that moment when the real personal digital assistant arrives. And we think that Pi, pi.ai, where you can access it online, is really going to be that assistant.
Mustafa, you use words like building, and I think about your past, your career, your time at DeepMind, Google. How important is it right now that you are basically moving from research to real-world introduction of a tool? A lot of people are calling to hit the brakes, right, on development. But that seems to be the point of differentiation, moving from development of future generations of models, or indeed the research arm, to having a product that businesses and consumers can use.
I mean, AI is now coming of age. I mean, this is going to be the meta technology of our times. It is going to be the technology that enables everything else, just like electricity or steam powered the last huge industrial, revolutions. And so that's very exciting for us because it's a very practical time. We're doing applied research. We're getting things to work in production and at scale with millions of users. And that's really the fun of it, is making these things very, very useful and seeing how they save time, improve performance, increase quality, and increasingly enable us to actually create completely new experiences that technology has never enabled before. I kind of think of this as a new sort of design material. It's a new clay that we can use to mold and create emergent, entirely personalized, and completely adaptive experiences which are going to feel very unlike the kinds of static user interfaces that we've had of the past. I mean, today, a website is a website is a website. It's just static and 2D, and it stays the same. Tomorrow, your conversational AI is going to enable you to experience dynamic, real-time generated, personalized user interface, and it will feel really magical compared to what we've had in the past.
Mustafa, what scares you in all of this?
I think what's amazing about this technology is that it is the ultimate force amplifier, right? Wherever there is a desire to take actions in the world, to generate new content, people are now going to have access to a tool that makes that easier to plan and to create. And of course, that's going to lower the barrier to entry to create chaos. And some people, with bad intentions will choose to, amplify the disruption, unfortunately. But I'm pretty confident that the vast majority of people are going to use these tools for incredible good. And that where there are downsides, like, for example, the spread of misinformation or the growth of counterfeit people which imitate, real humans, I think we're going to get control of that pretty quickly.
Mustafa, you're joining us from London. What are you doing in my old stomping ground, my hometown?
Well, this week coming up, we have a hackathon with our team. We relocate to a different city, every month or so. We get together and we work on a project. So you should expect some exciting new product features to be coming out in the next few weeks. It's just a great time to be building. So it's great to be here in London in the summer too.
Inflection AI CEO Mustafa Suleyman. I feel like I see you every week, but we're on a good trend. Thank you so much for your time. Now, coming up, good to see you. Airbnb is disputing data that suggests supply in some US cities is far outstripping demand for rentals. We'll get the details. And really quick, we're looking at shares of one particular name, Apple, up 1.5%. Why? $3 trillion market cap, the first company to do so. Historic day in the world of technology. This is Bloomberg. All right, time for talking tech. First up, the Netherlands published new export controls that will restrict more ASML chip-making machines from being sent to China. This new Dutch regulation will force ASML to apply for shipping licenses to export DUV systems as early as September 1st. And one of Apple's biggest suppliers, Foxconn, will invest about $246 million in two new projects in Quang Ninh, Vietnam. The plant's FECV and FMM vehicles Airbnb, Foxconn were awarded investment licenses and will begin operations in 2024 and 2025. Plus, Airbnb is dismissing data in a viral tweet that suggested revenue for property owners in some US cities was down nearly 50%. Airbnb spokesperson Sam Rendell said the data is not consistent with Airbnb's and that the demand for short-term rentals is alive and well. Joining us for more to talk about this, Bloomberg's Natalie Lung. Natalie, explain this one to me. There was a viral tweet, we're going to show it in just a moment, that said basically people that have Airbnb homes, they're not making any money.
Right. So this viral tweet that came out around 2 days ago had data from all the rooms, which aggregates Airbnb and VRBO listings. Data showing in cities like Sevierville, Phoenix, Austin are seeing revenue per listing drop nearly 50%. And what's got people talking about this data is obviously the big slump, but also people were wondering like the accuracy and veracity of the data because there was another data source, AirDNA, which is also widely cited by the hotel and short-term rental industry